On the balance sheet under the equity section is the line item retained earnings. What is it? Why is it important? And how can we impact it? Retained earnings are the cumulative profits a company has earned since its inception. So it's a cumulative number, minus any dividends distributed to shareholders. It's a key component of shareholder equity on the balance sheet. Retained earnings are crucial for a company's long-term growth and financial stability. Here's how I like to think about it. On the P&L or income statement, we can see how much profit a company either made or lost in a period of time. The retained earnings, however, is all the profit and loss of the company since the company has existed. Think of it as a big bucket of cumulative profit. What increases the retained earnings? Well, a company makes more profit in a given period of time, be it a quarter or a year, then the cumulative amount of profit that is retained by the company goes up. What decreases retained earnings? Well, if a company loses money in a year, a quarter, or whatever period of time, then the amount of retained earnings goes down, that amount. Now, there's another way that retained earnings can go down. If owners decide to distribute the profit back to themselves, then retained earnings goes down. Now, for a public company, this would be what we would call a dividend. This is the amount of profit that is no longer retained, it is distributed back to shareholders. Now, for a private company, it might be called a distribution back to shareholders or owner's distribution. In summary, retained earnings is the cumulative amount of profit a company has generated that has not been distributed back to owners. This is why it's called retained earnings. And remember, earnings is just another way or a word of saying profit. Now, the formula for calculating retained earnings is retained earnings equals beginning retained earnings plus net income minus dividend. Beginning retained earnings represents the accumulated earnings from previous periods. Net income is the total revenue minus expenses for that particular period. How can employees impact retained earnings? Employees contribute to increasing retained earnings by improving profits. Anything that you can do to increase sales, reduce costs, improve efficiencies will ultimately have a positive impact on retained earnings. Why is it an important business metric at all? Well, several reasons. One, business growth. Retained earnings provides a source of capital for business expansion, research and development, acquisitions, or other strategic initiatives without relying on external funding. Financial stability. A healthy level of retained earnings indicates financial stability and the ability of the company to weather economic downturns or unexpected expenses. Investor confidence. Shareholders and potential investors, they often view strong retained earnings positively, and it reflects the company's profitability and long-term viability. Debt repayment. Retained earnings can be used to pay off debts, reduce interest expenses, and improve the company's overall financial health. In conclusion, retained earnings plays a vital role in a company's financial strategy, allowing it to reinvest in growth opportunities and maintain stability. Employees contribute to the success of a company by influencing its profitability and consequently the level of retained earnings. Understanding and managing retained earnings is crucial for businesses aiming for sustainable growth and long-term success. Retained earnings is just one of many financial metrics and concepts. At Acumen Learning, we specialize in training individuals and organizations in understanding financials, understanding business metrics, understanding business acumen. If you'd like to learn more, please go to acumenlearning.com.